Hey traders, this is Blake Morrow with Trader Summit, and I'm always happy when I get to bring on Mr. Marc Chandler from Bannockburn Forex, the chief strategist over there. How you doing, Mark? Good to see you again.
Good. Happy New Year.
Happy New Year. Yeah, I guess it has been. It has been since we spoke was 2023. Well, it's great to see you. And so much has happened, and we just came off of a really big week. I wanted to start off, kind of get your thoughts on how you're viewing the Fed at this point. We just got past the FOMC meeting. Fed Chair Powell had an opportunity to deliver his message to the entire world via 60 Minutes on Sunday. What were your thoughts, or what are your thoughts coming off of those two events?
Yeah, sure. Thanks, Blake. It's always a pleasure to chat with you. So I would put like what's been happening so far this year in the context of what happened in the fourth quarter of last year. In the fourth quarter of last year, remember what happened. The market sees that the Fed has pivoted, takes down U.S. interest rates sharply, prices in aggressive Fed cuts this year, and the dollar sells off sharply. I thought that, and sort of like in trading, right? Sometimes I think of analogies with some sports, like in boxing. Some boxers are just the aggressor, and others are what they call counter punchers. They wait for the other person to punch, and then they react. And I think that sometimes being a counter puncher in the markets means this: seeing that the pendulum of market sentiment swung so far in Q4, it seemed almost, I want to say, unrealistic to me. That I expected at the start of this year for the dollar to come back and for U.S. interest rates to rise. And I had thought that when Powell's at the press conference after the Federal Reserve meeting, I thought that Powell was as clear as the Federal Reserve could be that the Fed was not going to cut rates in March. He basically said that, he says it's a question of confidence. And while the Fed is confident, it needs to become more confident that inflation is headed towards its target, and that it probably will not be confident enough by the next meeting, March. So the market quickly adjusted to that. And I think that the jobs data at the end of last week really helped. And I know there's some problems with the data. You look at the number of companies that are responding. You look at the household survey. Yes, there's some weaknesses, but I sort of think of it like that, that if you look too close to anything, it looks ugly. And when you step back, and what's the real takeaway? And I think the real takeaway is that the labor market, which Powell acknowledged is slowing, was still strong. And I think that's ultimately, it sounds kind of very general, but I think that, that's really what we could say about the labor market. It is slowing gradually, and that it's still strong enough to keep the Fed cautious about cutting rates.
Would you be? I wanted to ask you this about the dollar's response to all this, because I agree with you. The dollar was unloved and underappreciated going into the beginning of the year, since the last time that we spoke, which was right at the end of this last year, and the dollar has rallied. Sharply would not be the term that I would use, but it is grinded higher, and it seems like it ratchets higher every time we have some sort of event. But if you look between, the Fed meeting, the clarity that he gave, I thought, on the 60-minute interview, and where we currently trade right now, the dollar is not substantially higher. It's higher, I guess, argument's sake, it's slightly higher, but we haven't seen any explosive move in the dollar. And why would that be, in your view?
Yeah, I don't know. It's kind of hard for me to argue against like why there wasn't something. I sort of see the euro having ground lower. I was looking for I tell you, I had sent out a note in December. Look, I thought there was a head and shoulders top pattern in the euro that I thought projected down to about 106. But when I looked at the momentum indicators, I thought 106 seems too far away. And so instead, I found some earlier support levels, 107.65 and then 107 and a quarter. And we dipped a little bit below 107 and a quarter, but the move happened so quickly that I kind of wondered. That's why I kind of thought that today, Tuesday, while we're talking, could be, I thought this Monday afternoon, that maybe Tuesday was the sort of classic turnaround Tuesday, which really just gets to the idea after a 2 or 3 day strong move, there's you want to look for a counter trend move, a correction of some sort. And I think that's what we're having today. But the euro fell to new lows for the year. Sterling fell out of this 2-cent range. It's been in 126, 128 since the middle of December. Aussie fell to new lows for the year. Yen fell to new lows for the year, all since the Federal Reserve meeting and the jobs data. And I hear you about Powell speaking on 60 Minutes. How far we've come in our careers. Back in the, I think it was the early 90s, that book, Secrets of the Temple by William Greider, which is a huge tome talking about how secret the Federal Reserve is. And now look at it. They have a press conference after every meeting. The chairman goes on to 60 Minutes. I don't really think he said anything new. I think if there was an element of confusion, it was that narrator at the very end where he talked about Powell ruling something out. It's talking about a rate cut, rate cut in the middle of the year. And I don't really see Powell having said that in what he said on 60 Minutes or what he said after the press conference. It's clear that somewhere the Federal Reserve will be cutting rates this year. And remember, in December, the Federal Reserve does a summary of economic projections, which you can find on the internet, it's publicly available. And the median had 3 cuts priced in. So in the market at the end of last year was pricing in 6 or maybe even 7 rate cuts. I thought it was excessive. And I kind of suspect that they're going to meet somewhere in the middle, 3 to 4 cuts here in 2024.
Well, okay. Now you're talking into some more specifics. 3 to 4 cuts at some point in 2024. But before I actually get into this, I have to ask: do you think life in the markets is better the way they communicate now, or do you wish we could go back to the 90s and look at the briefcase indicator? What do you think?
Yeah, no, I'm a Democrat with a small d. I think that the power that the Federal Reserve has needs to be accountable. Europe has this idea. There's an old political economist, political scientist, says something like to the effect that power corrupts and absolute power corrupts absolutely. And I think that the U.S. version, the U.S. understanding, the U.S. contribution to political philosophy is that power might corrupt, and the best thing to do is hold it accountable. And the way to hold it accountable, even in these non-democratic forms like the Federal Reserve, is to have press conferences, is to make it more accessible. And so I'm all in favor of that. And you're right. There was a cottage industry of people when I began my career that were paid just to follow the Federal Reserve. The Fed would not announce its decisions. You would have to interpret them from the action in the market and from the Federal Reserve, the whole thing, all the data the Federal Reserve publishes about itself. And oftentimes they make the change in the middle of the day and without notice. And so, of course, I think this is, I think, the direction, we should be moving into best practices, greater transparency, greater visibility, and greater accountability, like we saw with those trading issues among Fed officials recently, or last year, or 2 years ago. They have to be held accountable. And I hope that we can make that same move to holding officials accountable we do for Congress and next for judges, for the judicial branch.
Okay, well, that's definitely a conversation we can spin right out out of control into. But I'm not going to go there right now with you, Mark. But I want to go back to your thoughts on 3 to 4 rate cuts in 2024. Let's start with you see them happening about mid-year. Why and what's going to get us there? Do you think?
Yeah, sure. So the first cut or two will not be spun, it will not be explained by the Federal Reserve as easing monetary policy. What they're going to try to explain is that as inflation has fallen, this pushes up real interest rates which means that policy becomes even more restrictive than it might have to be. And so in order to preserve the odds of a soft landing to the economy, the Federal Reserve wants to maintain the level of restriction. And to maintain the level of restriction in a falling inflation environment means to cut the nominal rate. So the first rate cut or two will just be under the guise of maintaining the current level of restriction. But I'm in that camp that says, yeah, we've been able to avoid a recession so far, but the economy is slowing down, and we should expect a further slowdown as we into the second half of this year. I think the election itself is going to slow things down for businesses making capital investment decisions if they think they can get a corporate tax cut next year or some accelerated depreciation allowance. So I look for the U.S. economy to slow. So the first couple of cuts from the Fed will be just maintaining the level of restriction. The next few cuts will be more towards helping to support the economy.
Okay. Well, speaking of the economy and not our economy necessarily, let's shift gears a little bit to China because, um, we've seen some action we've seen a lot of action actually
Yeah.
from China over the last several weeks, but and I could go back to a week ago and say, but it seems like it's making a dent what Xi is doing. Markets were up. Markets gave back all those gains last night. There seemed to have been more action from Xi in China supporting the markets. And then we've seen a turn in some other markets. We've seen Japan start to come off a little bit. We've seen yields come down, yen strengthening. What are you making? What do you make about China? And are they going to be the beneficiary? And if China is going to gain, who's going to lose in this whole situation?
Right, sure. Yeah. So, I worry that of course China is the 800-pound gorilla in the room. I think that if there's one thing that the U.S. political elite seem to agree on, it's that China is a key adversary and it's going to eat our lunch if we don't do something. And I get concerned that we have a double set of standards. I mean, think about the property market. So we all talk about Chinese property market. They purposely deflated their bubble, and they're still sort of living with the consequences. Here in the U.S., last week the regional bank index fell by about 7.5%, which is the most since last March, and that's because of the U.S. commercial real estate problem. And if you look at the Federal Reserve, they do a study. They put out a report. I think it's 3 or 4 times a year, the Financial Stability Report, and commercial real estate is big in there. It's like really prominent. And so should Americans be worried about the Chinese property market? I don't think so. Should we be worried about our commercial real estate market? Probably. And it's not just, so China's had this bubble and they've popped it. And yet, is there really global implications? I don't think so. But last week we saw a Japanese bank get sold off hard because of their exposure to the U.S. real estate market. The largest German bank, I think, quadrupled their loan loss reserves put aside for U.S. real estate exposure. So I think that large foreign investors, have exposure to the U.S. real estate market in a way that they don't to China. And so I think that the U.S. real estate market is more of a thing I think that should keep us up at night or thinking about it more than the Chinese property market. When it comes to the Chinese stock market, you're right. What a horrible start to the year, which comes after several years of losses. So on one hand, I'd say, well, there's some value there. On the other hand, it's hard to know what you're really buying. When you buy Chinese stocks, are you buying an ADR? Are you buying the stock that's listed in Hong Kong? Are you buying some other security? What are you really buying? But we talk about the Federal Reserve put, and that was the idea that the stock market would sell off very hard. The Federal Reserve would take action to prevent financial instability. Is China really doing that much differently? I'm not so sure, but I agree. Of course, they have different institutions. We have we don't have so many state-owned banks because they're not in crisis now. It's only when they're in crisis they become state-owned. And same thing with the large U.S. companies. And so we don't have the kind of statist control, but we do it our own way, separately, but with the same kind of things in mind. Avoid a destabilizing sell-off in the stock market. And so I think China's trying to do that. Whether they succeed or not is a different story. I suspect they will succeed. There's a saying, don't fight the Fed and don't fight City Hall. Beijing is City Hall writ large. And so I think that the communication channel, like, for example, in the Federal Reserve in September of 2021, Powell said, okay, we're going to have to begin raising interest rates soon. He didn't tell us when. And they didn't hike rates until March 2022. And when they did, in those 6 months, the U.S. two-year yield jumped 50 basis points. And I think that communication channel, that would say open mouth policy, giving that kind of forward guidance. And there's this political economist, political scientist, Charles Lindblom, and he wrote a book called Politics and Markets. And he suggested the market system is thumbs, is being very nimble. And the more statist type policies are all fingers. They're more clumsy. But I'm not sure that there's like such a big difference. To me, the threat that China poses is not about the economy. We've had other competitors that have used industrial policy, subsidized industry, subsidized exports, pursue weak currencies. We know how to compete with them, and we can do so successfully. The challenge I think China presents is not just on the economy, but on and like politics in expanding their sphere of influence. And I'm not talking about Taiwan. We all know where Taiwan is, but the U.S. does not have a military agreement with Taiwan. We do with the Philippines, we do with Japan, and that is where China is making inroads. China is also doing a land grab just over their border in Nepal and Bhutan. And to me, these are the problems, not their economic competition. And I fear that we in the US, many of our elites, make China look like it's 10 feet tall and eating everybody's lunch. And instead, I think that President Xi has done China a big disservice. China is weaker now, even if its military is strong, its economy is weaker. People seem less satisfied with the economy than they were before. The ability to double, think about what China's done. Per capita GDP is more than doubled
Yeah.
in a generation. More than that, quadrupled since 1980. And I don't think that China can continue to deliver those goods. And that to me is the big threat of the big risk is what we see in political science. It's sort of like unfulfilled expectations. And I think China can't continue to fulfill those expectations that people are going to continue to have this huge growth in living standards.
So do you think the beneficiaries there are going to be countries like India, countries like Mexico, closer for us as Americans, it's obviously would be a natural selection. And for Asia, be more India. Is that what you view would be Xi's disservice that he's doing to his country longer term? And they're obviously going to run. This is a whole different conversation too that we're getting into, but they're going to have demographic issues.
Sure.
I mean, big ones coming up in the decades ahead, right?
Yeah, I think what China's been able to do is something that the U.S. has failed to do, and that is to get Japan and South Korea to have a rapprochement, for them to begin cooperating more. This is the first time I'm really seeing this, and I think that Xi has a lot to do with bringing those former sort of tense frenemies, if you will, together. I do think that India is a very interesting case here. India is years behind China in development, but starting in June of this year, Indian bonds will be included in the JP Morgan Emerging Market Bond Index. And this is already getting some fund managers to get ahead of the game, beginning to buy Indian bonds. I think Indian bond yields, 10-year yields, are down about 10 basis points this year, while, of course, most other countries' bond yields are higher. The other kind of interesting thing, I think, is both Americans and Japanese seem to be big buyers of Indian stocks. And so in effect, then, if it could be like if there's one portfolio, what they're doing is they're selling China and buying India. And I think it's interesting. I mean, India is close to democracy, I suppose. India does have elections coming up in April and May. Prime Minister Modi looks like he'll have a third term. And when I look at the currencies, India rupee is the only emerging market currency that has risen against the dollar this year. And even there, it's very slight, but being able to hold its own against the dollar tells me about the foreign demand for Indian stocks and bonds. While in China's case, I think that who's really selling Chinese stocks? Most of us, I'd say in the US, lightened up our holdings of Chinese stocks, looks like last year or so. But the Chinese themselves seem to be dumping Chinese stocks, buying US ETFs, buying gold. And as they move out of their own currency, it of course weighs on the RMB.
So, okay. Lot to digest with China. And I think this is such a fascinating conversation, but I don't want to take all your time in this. But Mark, we definitely should continue this conversation at some point. I want to ask you this, since we're on the Trader Summit. We've seen the dollar oscillate higher against most currencies. It seems like to me that we are in a race, central bank race, like who's going to be cutting first. So as we wrap this up, where do you think we as traders should be currency wise, and what's going to be the central bank that will indeed pull the trigger first? Non-LATAM, obviously. LATAM's a whole different animal, but G10. What are you thinking right now? It's like where should we be trading wise?
Yeah, so I think that, since the start of this year, the dollar has been moving higher. When I look at the momentum indicators, so in the short term, I tend to put more like weight on momentum indicators and on how markets respond to like news developments. And that's like the jobs data, or how the market's positioned, that kind of thing. And I think that this leg up in the dollar has just a little bit more room to go. Why I say that is because I think that's being driven by the interest rate adjustment, and I sort of had the 2-year U.S. yield moving closer to 4.5%. And I thought that was like sort of more or less fair value. So I could see that this leg up in the dollar, which I'd say began maybe FOMC meeting, maybe it's the jobs data, has a little bit more room to go before we get the first sort of bona fide dollar pullback this year. And so what levels am I looking at? Maybe it's 107 on the euro. Maybe it's a bit lower. I'm not sure we go to that head and shoulders objective closer to 106. I'm not sure that dollar yen gets above 150. I'm not sure that that sterling goes much below 124.50 or so. So I think that we're close to a place to begin looking for the dollar to pull back. We might not be there quite yet. I sort of see today as it's sort of consolidation, and the fundamental news. I think the race we're having really is this new divergence. Europe, that's the Eurozone and the UK seem to be stagnant. Now, the Japanese economy contracted in Q3. They're likely to have expanded in Q4. We know China is still in trouble despite their 5% GDP print they claimed. So I think that there's a new divergence taking place where the U.S. economy expanded faster than people thought in Q4. And it looks like we're off to a decent start here in Q1, though it's a bit early for me in the cycle to really put much credence into the Atlanta Fed's GDP Now forecast, a tracker. I think it's 4.2%. I would imagine we get something closer to 2.5% to 3% here in Q1, which is above trend growth, which means just more of the argument about why the Fed is not going to be the first one to cut. I sort of see the ECB as most likely the first to cut. And I suspect both the UK and the Eurozone are going to see a sharp drop in inflation in the coming months. And that's really because it's not really rocket scientists or my forecasting skills. It's really because of a huge jump in inflation in the Eurozone and the UK starting like February through May last year. Those numbers get dropped off the 12-month comparison. We're going to see a big drop in inflation. I think that'll give both the UK and the ECB some scope to cut interest rates in the May-June period.
Okay, and so this U.S. exceptionalism story, you're still not sold on it then? I mean, that was the story of 2023, but going into the rest of 2024, you're not quite there yet.
Yeah, I'm not there. I think there will be new convergence, and it'll be that the U.S. economy slows down. Again, it looks more like a second half story than a first half story.
All right. Well, Mark, I tell you, you've always been, and I mean, I've spent the last 20 years, even when I made the transition from trading equities predominantly to currencies back in 2001, 2002, you still remain the original person that I read your books. I would read your blog that you still have today. How do we educate, if you're a trader and you want to learn more about currencies, what's the best way to follow your work? Because you are really one of the kingpins in the FX market. So how do we do that?
I think I'm a small fish that has. I sort of feel like Thomas Edison. He said once he didn't fail. He found 10,000 ways it didn't work, and I sort of think that it seems to me there's only 3 ways to make money. You either go with the trend, you play for some mean reversion, or you're doing some kind of a carry arbitrage type trade. I think there's lots of ways to lose money, and I keep finding new ways, I think. And so I think that the number one thing in the markets is not being right more often, but it's really risk management. And so and that's what I really like about people. A lot of guys like me, my age, they aren't thinking about technicals. They really think about macro and fundamentals. And yet for me, the technicals allow us to really quantify our ideas and know where we're wrong. We all know what to do when we're right. It's really how do we react when we're wrong. And so I try to combine. I try to like see the world integrated between the prices and the macro. And I keep that blog, like you say, on marktomarket.com. I also keep stuff on Twitter. Or X or whatever he's going to call it these days. And I like that. I mean, I see a lot of banks also, economists putting out their stuff. Asset managers putting out their commentary on X as well. I'm there, Mark Making Sense, and that's really a title. That really comes from my first book, Making Sense of the Dollar. But I'm around. My DM is always open. I'm always happy to engage with people. And so yes, follow me. My blog, and follow the tweets on Twitter.
And just before Mark and I hit record and we were chatting, and I had to let everybody know, or let him know, I'm like, I love reading your work in the morning because he's on the same schedule as me. He just happens to live 2 hours in a time zone that's 2 hours ahead of me, but still at the same sleep schedule that I have. So therefore, when I get up, he's already done a lot of the work. So I love that. And I love that about you, Mark. And I really, truly appreciate everything you do. And if you guys and gals love this conversation, make sure you give Mark a thumbs up, subscribe to the channel because it's free to subscribe to YouTube channels for those of you that did not know that. And make sure you comment down below if you have anything that you wanted to add to this conversation. So Mark, thank you. I really appreciate your time. And I know those of us here at Trader Summit appreciate you as well.
Thanks, Blake. Good luck to everybody.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.